Welcome to the deep dive video update. And I want to explain deep dive right away because it might be a little bit different context than what you thought if you're watching this video for the first time. Every week I do a whole lot of different videos and I look at hundreds and hundreds of charts and I pick out those charts and I put them into this particular video that I really didn't use, or maybe I used earlier in the week and they're not really telling us all that much right now, and I put them into this video. But I call it the deep dive video because we have to look deeper. Sometimes we might get some clues about what's happening by looking at these charts. In addition to that, I also have other charts that are unique just to this particular video. And this is being prepared for Monday, September 8th. This first chart I only show in this video, and it's a chart of the VIX, which I've turned invisible. And then over top of that is a 50-period exponential moving average of the VIX. What we're focused on right now is way over on the right-hand side. We can see that this is coming down and it's below 20. That's what we see in a more positive environment. Even when we were going up earlier in 2025, we never got above 20. We got kind of close. It was getting a little scary there for a while. But then as we were coming up out of the April lows, we started to see the VIX come back down. We can compare that. This goes all the way back to 2005 to show us the different ranges. This was the great financial crisis here. Then we came up out of that. Then this is a whole COVID crash and the resultant bear market that happened back in 2022. And then we come down into a lower range. And that's why we're seeing things more positive, at least when we look at sentiment longer range. All right, then we want to keep an eye on the momentum of the VIX. And I use a MACD to measure that. We're still pretty much flatlining. We go up a little bit and then we're coming down. I don't focus as much on this chart when the VIX is under 20, because when we get above 20, that's when we're seeing elevated fear in the market. And pretty much it's been kind of comatose. We're not seeing a lot of conviction in the market right now, even though we set an intraday all-time high on Friday with the NASDAQ and S&P 500. We're not seeing an awful lot of conviction, not a lot of real push to have prices go up. And the market's dealing with a lot right now, including coming out of the summer months. And so we're seeing things slow down a little bit, which is not all that surprising. But in the meantime, since the MACD isn't really giving us any additional insight, I stopped using that, at least for right now. And we also want to keep an idea on the momentum of the VIX using an RSI 9 periods. And I use this like an overbought, oversold indicator. When we're getting a very high reading, we'll go above 70. That means the VIX is getting very high very quickly. And when we're getting a very low reading, that means we're really going up with stocks and the VIX is dropping really quickly as well. Right now, we're just a little bit below the midpoint. I only show this chart when we get extreme, either above 70 or below 30, and we're not there now. We look at the VIX and then a correlation of the VIX with the S&P 500, seeing a little bit of an upward move here. But we really only get concerned if we get all the way up to the dashed line. This is also showing that fear is rather subdued right now. If we see a real spike up and for this to continue to go up, then I'll be showing this chart again and we'll see probably a little bit more fear coming into the market. But we're just not seeing that right now, at least on a consistent basis. And we look at the VIX and then do a ratio with the VVIX. This is the volatility of the VIX, and then we compare the two. And we've been coming down here, and then to give it a little more smooth effect, I have a 50-period exponential moving average. And in this context, we've been going up with the S&P as this moving average has been going down. It's still going down, and that is longer term positive. We look at the Ulcer Index, which just uses closing values. It was really developed to work with mutual funds, which only have one price that is calculated after the close. And I only show this chart if we go above the moving average. Well, we're well below the moving average, and that's also showing there's not a lot of fear in the market right now. We look at the volatility of stocks, that's the VIX. We look at the volatility of bonds, that's the MOVE index. And we saw a really big drop down here. The bonds are acting kind of strange right now. They picked up in volatility, but they're also going up based on price. And we're seeing interest rates really coming down. What I focus on more for this chart is what is the direction of the red line? And what has the stock market been doing as this line has been going down? Well, we've been going up with the S&P. And so as long as this moving average continues to go down, that is treated as more positive. We look at large cap growth here, which we're coming off of an intraday all-time high, and we're near all-time highs. But you can see a lot of sideways action here, not an awful lot of conviction really breaking to the upside. But this is still positive. And when large cap growth is doing well, the stock market is doing well. We look at high beta versus low beta, really choppy right now. We see a bit of a down move, then an up move, then a down move, then a bit of an up move. And I usually focus on this chart more when we're seeing a more definitive either up move or down move, like we were seeing earlier in 2025. We got into the end of July, we kind of topped out there, and we've just been chopping around ever since. There's times when I might show this in a daily video, but I haven't been using it very much lately. A very similar thing here. Now, we want to keep an eye on this because this is actually possibly starting to change character. When this is going up, that means that large caps are outperforming small caps. But you can see we're starting to come down now. We were range bound for quite a while. Small caps like a lower interest rate environment where the economy is still doing pretty good. And that's kind of where we're at right now. There's some fear. That's one of the reasons we're seeing bond prices going up and interest rates going down. With the weaker than expected employment report that came out on Friday, there's some folks that are nervous about the economy and they think maybe we've topped out with interest rates. And so we better get into that area of the market, meaning bonds, now. And because we're going to see interest rates going down from here. We don't know that for sure. We've seen this happen before, and then it switched and turned and went back the other way. We still have the Fed that they're going to be coming out and probably cutting interest rates, at least according to the market. There's going to be some kind of a rate cut, probably 0.25%. But small caps tend to thrive more in this kind of an environment. Now, you notice here, back in 2020, when we had the whole COVID crash and everything was just going crazy, we saw this ratio really coming down here. We finally bottomed in 2021 and then we came up, and that was a really strong year for the market. And then we hit the bear market of 2022, where we pretty much went sideways for the whole year here. And then large caps regained leadership and we went up in 2023, 2024. Now we've kind of stalled out again. So we'll be keeping an eye on this to see if we're going to see more of a change here. We see a little bit of false starts along the way, but for right now, we're just observing this chart, not necessarily making any conclusions on it. Then we look at high beta stocks again to the equal weight version of the S&P. When this is going up, that means the market is more risk on. When this is going down, the market is more risk off, and we're usually declining at that point. Really choppy. And we've been this way now for a few months. And so there really hasn't been a lot of insight that we've gained from this chart. And just for informational purposes, the percentage gains going back to the October 2022 low, the October 2023 low, and then the April 2025 low. And this is actually calculated using a spreadsheet. So these percentages are a little bit more accurate compared to a chart that I'm going to show you later where I have to eyeball how much of a gain or loss we've had. We want to keep an eye on this. Now, it's not a problem right now, but if we go above this blue dashed line here, that means that we're 10% or greater away from the 200-day simple moving average. And in the past, over the last few years, that has created a problem. Now, there's no magic about the 10% level. We just use that as a round number to work from because we came up here, we were about 12, 13%, and then we topped out, and then we had a fairly significant decline after that. Then in 2024, we were getting far away, but we stayed far away for quite a while. And then once we finally turned and came down, we saw a pretty significant decline here as well. Now, I did a video that I put on YouTube back in July where it's like, okay, we had pretty significant declines in 2023 in July and 2024 in July. Didn't happen this year. One of the reasons I said, okay, we don't need to be as worried about it now as maybe before, because we're not further than 10% away from the 200-day simple moving average. Okay, so this is something that we're keeping an eye on, but we're really only going to get concerned about this if we go above the dashed line, which is roughly at the 10% level. Then I haven't been using a lot of advanced decline studies other than the ones that you usually see in the daily videos, just because they've been chopping around here, not really showing an awful lot of conviction based on price or volume for the S&P. We are breaking out here with the cumulative advanced decline line for the NYSE based on price, and we're breaking out a little bit here based on volume. So the broader market, at least after Friday, is showing a little bit more resilience than the S&P right now. And then we look at a regular NYSE advanced decline line, making a new high there. That's positive. And then we break it out again based on common stock here, where we're making a new high based on volume, but we're not quite there based on price. Now, this could be positive. What we've been seeing in the S&P over the last few weeks is volume actually leading price to the downside. We've been seeing volume going down more than we've been seeing price. Well, this is the opposite of that. We're actually seeing volume leading price as we're going up. Now, this is a broad market measure. So we'll have to see, is this going to come over into the S&P itself? And is volume going to start to lead price there? It's not doing that right now. But that could change. We could have a good up day or two, and it could switch that whole scenario right there. We're just watching it for right now. But we are seeing it there here on a broad market measure. Now, you could say that this is a negative divergence since we're setting a new all-time high based on volume, not a new all-time high, even though we're close based on price here with the NYSE common stock. I see this as more positive than negative, but you may have a different interpretation of this chart. Then we look at a long-term average of the S&P 500 highs minus the lows, 10 days. That's longer term. And we're seeing a little bit of longer term weakness coming in. Now, we're not turning negative, but we were above the green line and still going up. And lately, we've been coming back down and we've fallen just a little bit below the green line. A little bit of vulnerability in the longer term right now. And then we look at another broad market measure, but instead of a 10-day moving average, this is a 5-day moving average of the highs and lows across another broad market measure, the Amex, NASDAQ, and NYSE. This is still looking pretty good. So the broader market is actually holding up a little bit better. Now that the previous chart was a 10-day moving average, it moves a lot slower than this 5-period moving average, but still, this is holding up a little bit better for right now. We look at momentum stocks, just kind of drifting now compared to the S&P 500. When this is going down, that means the S&P is actually outperforming momentum stocks. And these stocks held up better when we were just taking a dump back in March and into April. And then as we've been coming up out of that, we've been seeing the momentum stocks actually underperforming. Then US versus international stocks, a little bit of a longer term improvement here, but they really, if you go back to the beginning of 2025, US stocks were doing quite well. Then things started to switch and we saw US stocks underperforming, and they still are. They really haven't come back and take a leadership role yet. In some of the other videos, I have a US to international ratio that I look at, and international stocks are outperforming. Now, we see pockets of improvement along the way. It looked like we were improving, but now we're starting to level out here a little bit. Then some technical alerts that are put out by stockcharts.com. And these are the ones for the whole week, starting with Tuesday, because we had only 4 trading days. Down day, a lot of red. Up day, a lot of green. And then a mix here as we got later into Friday session. So you can look at this and just kind of tell whether it was an up day or down day by the color of the alerts that are triggered. I go through each day all of the alerts and just give a kind of simple explanation about each one. And we also use a thing called Scooter Scores, SCTR, and that tries to remove all emotion. Now, technical analysis is supposed to remove emotion, but you can have 10 people look at the same price chart and come to 10 different conclusions about what's going on. Well, this tries to take it to the next step and say, let's just look at the technical analysis indicators, puts them together in an algorithm, and then spits out a score from 0 to 100. The higher the score, the better looking that index. Now, you can do this on an individual stock or a sector. I use this with indexes. And coming in first place is the NASDAQ. Now, this is 1Q. This is the ETF for the NASDAQ composite. This is still looking pretty good. And we wanted to get up into the 90 range. That's when it's really looking good. But 86.8, that's respectable. But it's been kind of going along sideways here for the last month or so. Then in second place are small caps. Yeah. Going back to the end of July, we were actually down at 10 and we were dropping below 10 at times. Now, small caps have really started to improve and they're coming in second place at 86.3. Then we have the QQQs, which is the ETF for the NASDAQ 100, the biggest growth stocks that make up the NASDAQ. Still respectable, but lagging a little bit behind here at 79.7. Then we have the S&P, which is a balance between growth and value. It tends to hold up better when we're going down, but it also tends to underperform when we're going up. But this is the index that I focus on most. It has the most volume, it has the most liquid options, it has a lot of strategies that you can do to protect yourself, to produce income, and to generate greater returns. but it's coming in next at 67.7. Then we have mid caps, which are improving. They were down here in the 10 range as well just a few weeks ago, and they are coming up. They like this lower interest rate environment as well, coming in at 66.8. And then we have the Dow. That's in last place right now and actually under 50. Recent all-time high there, but not really showing a lot of conviction when it comes to emotionally removed technical analysis. All right, then a short-term rainbow. This is a 10 period moving average all the way up to a 50 period moving average, and I changed the color so it looks kind of cool. Ooh, ah. And we see that the lines are going up and prices above the lines. So in this aspect, the short-term trend is still positive. Now I measure the short-term trend by the 20 period moving average, and we dropped under that about a week or so ago, and we were actually turning negative, but we got that back pretty quick. Now we're back above it here, and so this is showing that the short-term trend continues to be positive. Now we have an intermediate term rainbow going from 50 periods up to 100 periods. Lines are going up, price is well above all the lines. Intermediate term trend is positive. We're seeing some weakness internally if you go through the daily videos, but we always see some weakness in a lot of areas. The only time I get kind of nervous is when everything is looking good all at the same time. That's about the time we've topped out because the market likes to climb a wall of worry. And if it can't find something to worry about, it'll create something to worry about. And so we always pretty much see something like that happening. Then we're keeping an eye on the 50 period moving average. Now, I did show this earlier in the week when we dropped below the 20 period moving average, but then we quickly went right back above it. And so now we're still above the 50 period moving average. This is the intermediate term trend. The lines are still going up. We haven't even really tested that. I brought this up because we were kind of close, but then we saw a nice little bounce up. We filled the gap. And instead of filling the gap and going down, so far we've been able to fill the gap and go up. Friday's bar is not all that encouraging. We set an intraday high, but we set the high right at the open, and then we came down, but we closed well off of the low at the same time. So even though it was a down day, you could treat this as negative. So for right now, we're seeing a similar pattern to what we saw when the employment report came out a month ago. We gapped lower. Now, this actually happened when the report came out. We saw a weak Thursday, and then everybody freaked out about the employment report. We gapped down, and then we came up out of that. We were setting what's called a bearish flag at this point. The perma bears were just salivating, thinking, okay, we're just going to tank from here. We didn't do that. We just kept going up, and we set new all-time highs. We're seeing kind of a similar thing to this point. Now it'll change at some point, but we actually gapped down here. This was earlier in the week. This isn't when the employment report came out, but we did gap down, and now we've been setting a series of higher highs and higher lows to this point. Now, this is only 4 bars, and at some point, this pattern is going to be disrupted here. But for right now, it just shows that we're holding up fairly well. 100 period moving average, still well above it, still see the lines going up. No need to show this chart. Now, there are times when we get far away from either a 20, a 50, or a 200-day moving average. We're not far away from it right now. We spent a lot of time way far away from the 20 period moving average and a lot of time away, too far away from the 50 period moving average, because how this works is if we get too far away with price, is it has a tendency to snap back like a magnet or a rubber band and come back to that price. And that's why I call it the boom indicator. It gets too far away and boom, it comes back closer to the moving average. We're not far away from any of these, too far away anyway, from these moving averages right now, so I haven't been showing this chart lately. And then we have some anchored moving averages. I did show this a time or two throughout the week because we fell down below this orange anchored moving average here. We had broke below that, but we only spent that day below it, and then we quickly got back above it. There's another moving average here. Now, these project forward instead of regular moving averages that use past data to come up to their current value. These actually try to anticipate what price will be going forward from here. And we're above all these lines, and all the lines underneath it, longer term anchored moving averages, they're all still going up. And so that's positive. And the Connors RSI, another momentum oscillator. I only show this if we go above the black line on top or below the black line on bottom. Not doing that right now. Then this is the other chart where I kind of have to eyeball this, so don't take these percentages as gospel. You move these things just a little bit when you're adjusting this, and poof, the whole percentage thing just changes really fast. What I'm going to be watching for on this chart hasn't happened yet. That's why I haven't been showing this. If we do get to the point where we top out and then start to come down, I'm going to be watching the percentage loss at that point. Because when we get down to about 10%, that's usually when we're having a decline. Now, I do this intraday. This is officially counted on a closing basis, but I like to keep intraday values going too. And we really came close to going into a bear market. Now, we closed down 21.4% on an intraday basis, but we were less than 20% on a closing basis. And this is when the smart money really started to come in and start buying. Other times, if we get down to that 10% level, we tend to come up out of that if it's just a pullback. And you can see that various times here. So we'll just be watching this. And if we do start the decline, I'll be keeping track of the percentages and we'll see how far down we go if we stop going up at some point. And then just to keep an eye on the S&P 100, it's actually doing quite well when compared to the S&P 500. The mass index is not generating a signal right now. We only generate a signal if we go above the red dashed line and the blue line and then come back down to the red dashed line, and we're not there. Standard deviation, this is how fast we're moving, either up or down. We're kind of not moving all that much, really choppy these days. And so we're not, over the last 10 periods, not seeing an awful lot of movement. Composite, CMB composite index. I was showing this back in August. We were getting extreme positive. That's when I showed this in the videos. But since that time, we've been pretty range bound here. So I haven't been showing this chart. And then the percent B indicator, that's when we close above or below the upper or lower Bollinger Band. We opened above it, but then we closed down below it. And so this is based on closing values here. Now we're still positive since we're above the midpoint. And there's books, thick books, written on how you can implement Bollinger Bands. This is just one of the ways, the percent B indicator. And the point and figure chart, even though we got close to an all-time high, it wasn't enough to generate a new green X here, but we're still looking positive longer term. And we're working on an ascending triple top breakout that was generated back on August 13th. So when you look at this, and this doesn't take time into account, whether it's an hour or a year, the X will only be drawn in, or the O will only be drawn in when that price has been breached. And there's pre-configured amounts in this point and figure chart. So we look at this all together, and it's still looking quite positive, though. A long-term rainbow, 50 periods up to 250 periods. Above all the lines are going up. Long-term trend is positive. This is also a long-term oscillator. There's a weekly version of this chart that I go over in the weekly video. That's positive and has been positive. This one spent a lot of 2025 being negative. That's when we drop below the red line. I usually only show it in this video and maybe the what to watch video because we didn't even get any signals at all in 2024. And we only had, well, we've had two now so far in 2025 when we dropped over negative and then when we crossed back over positive. And then this is an apples to oranges comparison. The S&P 500, which is only 503 stocks, and then the NYSE Advanced Decline Line, which is a very broad market measure. Not showing this lately because we're not seeing much of a disconnect here. We're seeing the broad market holding up as the S&P has been holding up. And then a weekly chart of the S&P on top, the German DAX, that's the biggest market in the EU. And we're seeing a little bit of weakening here with the correlation between the two, but they're still having a tendency to go in the same direction at the same time. And then support and resistance, we're well above the Ichimoku cloud. The green line, for the most part, is still going up. So is the blue line. The red line's kind of flattening out. That's longer term, but it turned up just a little bit here. And since we're above the cloud, we're getting plenty of insight from other charts than just looking at this one. Broad market, the VIXen, gotta love that name. This is the volatility for the NASDAQ 100. And we've been declining with volatility just like we've been seeing in the VIX. And then we look at the S&P on top, and then this is supposed to be a growth to value ratio, even though there's growth components in the Dow. And then look at the correlation between the two, and they're pretty strong right now. That's holding up fairly well. And then we have the Dow, which is just coming off of recent all-time highs, and then the transports, that's in red. Now, this would be considered a Dow theory non-confirmation because we're setting recent highs with the Dow, but we're not setting them with the transports. Some people who are more purists when it comes to Dow theory, that's a big deal to them. I look at other things as well, but we just want to keep an eye on how are the transports performing in relation to the Dow itself. We look at regional banks, those are smaller banks, and then do a ratio with the financial sector. This is actually looking pretty good. What really caused this to dump? This is when Silicon Valley Bank fell off a cliff and then Republic Bank. And then we were kind of stabilizing here. And then we saw another big dump when New York Community Bank said, oh, we're having some problems now. And we haven't really recovered from that. Maybe we're starting to see some improvement here. We're above these moving averages. And if we stay above this, we might actually generate a golden cross with this ratio. Then the bank ETF. Now you can see it open and set a high and it closed well down. We're a little bit concerned about the financial sector, and a big part of the financial sector is the bank ETF. Now, in the bigger picture, this is still looking quite positive, but Friday's bar is not all that pretty. And then we look at a ratio between energy to the 10-year for going back to the early part of 2023. We've been going sideways with this ratio. This is when we're really concerned about inflation. If we see this really starting to go up, and this was giving us some warnings back in 2021, beware, beware. And then we went into the bear market in 2022, and this ratio just kept going up. That was a great time to be in energy. Not a great time to be in stocks or bonds at that point. And then since that time, going back here, like I said, 2023, we've been just going sideways with this ratio. We keep an eye on gold, which it was up, it's breaking out right now, and the S&P, which was up, but only 1/3%. That's why this ratio is going up. And we're going to see if this continues to go up, this long-term trend line. This goes back to 2016. There's another high that we set here with this ratio in 2020. And then we came up here in 2025. And so far, this looks like pretty decent overhead resistance. If this continues to go up, we'll make that more notable as to actually happening. Right now, it's just kind of going up, but it hasn't really broken anything yet. And we look at emerging markets versus developed markets. Like developed markets would be European markets and US markets. Really no decisive move one way or the other. Earlier on, they were underperforming in 2025, but since we've stabilized a little bit here. And then the US 10-year yield and the German 10-year yield, and believe it or not, we compare that to the dollar. And we had seen things going a little bit crazy here with the correlation, and we're actually going in opposite directions. Where if you look at this chart, we spend most of the time up in this blue area, and things are starting to stabilize a little bit now. The German DAX, the biggest market that makes up the EU, not seeing the strength, not seeing a lot of weakness, but it has fallen below its 50-day moving average. And then when this is going up, that means that US stocks are actually outperforming German stocks. Now, they were really underperforming earlier in the year, and then we had all the gyration throughout the spring. And then we've been seeing a gradual improvement here. And we would like to see this ratio going up because it's usually more positive when US stocks are maintaining a leadership role. And they are improving when compared to German stocks, but not necessarily improving that much when we compare them to the rest of the world. Then some rate of change charts. I use these just for long-term information. Still going up here with this chart. This is also 250 periods, but it goes all the way back to 1980. And we're still looking fairly good there. And we look at bonds. And I look at this because you might hear things about, oh, the economy is going to fall off a cliff. Oh, inflation's off the rails. Well, what's the market saying about that? Well, we look at a number of different charts here, and I also go through these in the What to Watch video. That's really all that matters is what the market says. Doesn't matter what YouTube video you watch or what opinion somebody throws out there. What's the market saying? Now, the market is always right. It may not be correct, but it's always right. And for right now, we're seeing this ratio going down. That means on a short-term basis, the markets are not worried about inflation. If this ratio was going up, then they would be more concerned about inflation. They're not concerned right now. We use that same approach and look at tips. This is what folks get into when they're worried about inflation and interest rates going up. The ratio goes up. Well, it's not really going down, but it's not really going up right now either. It's just kind of floundering around right here. We'll keep an eye on this. If this really starts to go up, then yeah, there might be some inflation concerns that are coming into the market, but they're not really entering right now. That same thing, instead of 3 to 7 year bonds, we look at 7 to 10 year bonds. This is actually going down. You notice the previous chart were going up. Longer term rates were actually coming down a little bit here. So we're not seeing any real confirmation at this point. Then we look at the S&P, which is in red, and the long-term bond based on price. Man, it really went up as interest rates came down in Friday's session here. We're seeing a little bit of strengthening with the long-term correlation, a little bit of weakening after it had been improving with the shorter-term correlation. This just attempts to look at what are stocks doing in relation to the price of the 30-year bond. And we just keep an eye on this and look for anything crazy that's happening. And there are crazy things happening, but not necessarily off the rails crazy. And then we do that same analysis here with the QQQs, which on this chart are in black. And instead of being blue, we have the TLT. That's the long-term bond, which is in red. Seeing a little bit of a pickup here with the longer-term correlation there. And then we keep an eye on the 2-year yield, which has been declining, and that's been more positive. We kind of topped out right at the end of 2023, and we've been setting a series of lower highs here. And actually, if you could make a case for a few lower lows, although it's not as convicted in that area. But interest rates going down, that tends to be more positive for stocks. And we look at some ratios. And sometimes I show these all the time, and they're the focus of the video. Not right now. We look at the staples, which are defensive, to tech, which is growth ratio. When this is going down, that means staples are underperforming. To say it another way, that means tech is outperforming. Really choppy over the summer months here, not seeing an awful lot of conviction. Although the bigger picture is that this ratio is going down, which is positive. That means tech is outperforming. That same thing, a staples to S&P 500 ratio. Going down longer term, that's positive, but not really seeing a lot of shorter term conviction currently. Want to keep an eye on retail since it's such a huge part of the U.S. economy. Now, on top is a ratio between retail and the S&P itself, and that shows how it's been underperforming. We are leveling out here, actually showing a bit of an improvement here with this ratio. Then we look at retail all by itself. It's in an uptrend. It's above both moving averages. We're above 50 and going up with the RSI. So retail is showing some improvement, not only by itself, but a little bit here when we look at the ratio to the S&P. And then there's some different ratios of growth to value. On top is discretionary to staples, and that's the weighted version of these sectors. And these are doing better. And it was about a year ago when we saw discretionary really starting to outperform staples. Then to make it a little bit more fair, this is an equal weight version because Amazon and Tesla are in discretionary. So whatever they do can have a really big impact. And so we use equal weighted versions where Amazon and Tesla get the same weight as all the other stocks in the sector. This has also been improving. So we're seeing a bit of confirmation here, even though it came down on Friday. And then we look at tech, which is growth, to utilities, which is considered to be value. Just not really breaking out, but not breaking down either. And then biotech, which is growth, to healthcare, which is value. Biotech is really outperforming, and that's more positive for the market. And overall, we've been improving when you look at hotels to utilities, even though it came down in Friday's session. Then we have what are called bellwether stocks. These are the main industries that make up the U.S. economy. And semiconductors, which are doing okay, but not really showing any leadership right now. The home builders are improving because they like that interest rates are going down. Seeing a little bit of an improvement, but not really breaking out with the transports. We are improving, as I just went through with retail. And we're seeing a bit of a move up here with regional banks, even though they closed well off of their high on Friday. And then we look at the Eurozone. This is another apples to oranges comparison. The Eurozone stocks to American bonds. Coming down a little bit here into the rainbow, but still the bigger picture is that the Eurozone stocks are outperforming 3 to 7 year bonds. And then I have these things called possible positive scenarios. I really only show them if we get above the green line to the top or below the red line to the bottom. These are the percent of stocks in the S&P above their 200-day simple moving average, and that's longer term. When we're really going all over the place, that's when these charts tend to tell us something. We can still have some takeaways from this chart in that we're above 50, and for the most part, we've been going up, even though we've been pretty choppy recently here. So longer term, this is still positive. Now we use that same basic analysis guide and look at those stocks in the S&P above their 50-day moving average, above 50, and really choppy lately here, but it's positive since they are above 50. We look at the mid caps, which are showing some improvement, but also really choppy. And then the small caps, which are showing a little bit more strength here. They're up into the 77.5 range. So we're seeing an improvement generally in this area. And then we look at an SPY to Staples ratio. Earlier on, and I even did a video about this last spring, it's like, uh-oh, we're seeing this ratio really going down. That means the market's getting more defensive. Well, it was, as we were just going in the toilet at that time. And I was comparing it to what we saw in late 2021. When this ratio started to go down, we didn't set the all-time high for the S&P until early 2022. So this was giving us some heads up. And that's why I did the video, because it's like, is this telling us something? Well, it was there for a while, but then it got over itself and it started to come back up. We saw this ratio improving and we're getting back and actually breaking out to recent highs here with this ratio. And that's more positive for the market. Thank you. I hope you found this helpful. Have a great weekend and I will talk to you in the next video.